we have to start out with retail sales. If you contrast the data out of China with the U.S., a wide divergence there. Our retail sales were solid, up 0.9 on control was great. And if you looked at the revisions, they were rather powerful. China, not so much. Your thoughts?
Yeah, that's a continuation of a trend that we've seen, and it's been talked about all year. The global economy is slowing. China is slowing.
Divergence.
The U.S. is not. That's the divergence. Can that maintain? You use an old Greenspanism, an ocean of prosperity. Can the U.S. stay that? The marketplace, I think, is starting to question that and starting to worry that we cannot survive in the current growth rate we are if everybody else is slowing down.
And obviously investors are wide awake. Look at all the signs. We see Fed funds for next year barely at pricing. You could argue no tightening priced in, it's that close. For 2020, maybe an ease is working in. Now let's contrast that with what's going on physically. Money coming out of stocks and bonds headed right into the money market. Numbers like 90 billion in money markets.
Yes, two things. One, the marketplace is priced in less than one hike for next year, and then you write an ease. The consensus of economists is 2 or 3 still. That's going to have to get resolved next week by Chairman Powell, where his head is on this. Investors are seeing the same thing that the markets are pricing in. Not only are they moving to money market funds, they're going from growth funds to value funds. They're going from long treasury funds to short treasury funds. They're going to low volatility funds, low duration funds. They're trying to de-risk themselves up and down the line, and even getting out of risky stuff like leveraged bank loans.
You read my mind. The poster child for that dynamic today are those loans. You have anything that you'd like to add to that?
Well, the record outflow out of the levered bank loans, but if you look at high yield and you look at investment grade, you don't see the same thing. You see some outflows, but nothing like that. Because
no. As a matter of fact, if you look at the security side, they've definitely widened. But if you then include 2 years ago, 3 years ago, 5 years ago, that widening starts to disappear.
Right, exactly. But what it is it's a de-risking. I still want to be in the credit space. I don't want to be in the riskiest part of it. I want to rather be in the space that looks like investment grade.
Now let's keep this superficial, and this is really superficial, but the notion of what the balance sheet's doing, which securities are kind of running off, maybe not getting replaced. Then I look at all the demand in money markets. Is there an implicit steepening built into the psychology of all that movement?
If the Fed was on hold, yes. But I think a lot of that steepening, what you're asking about the short end of the curve, that'll be determined next week. If Powell is hawkish, then we're right back on the flattening train one more time.
Well, let's assume for a minute that conventional wisdom is not the cornerstone of this Fed and stencils aren't their gospel. And I sense from Jay Powell that that would be the case. Right. If he's thinking and discussing the way you and I are, most likely curve steepening will ensue, and he will get much more dodgy with regard to how close we are to neutral.
I agree. If that's what he does and he backs off on the rate hikes and that less than 1 comes down, the economists that think we're going to get 2 start to come down, then short rates could start to back off and you could start seeing some steepening.